We're joined now on that note by Rick Reider. He's BlackRock's CIO of Global Fixed Income. He is head of the firm's allocation team as well. I'm glad we could catch up with you, Rick. Welcome back.
Thanks a lot. Thanks for having me, Scott.
I assume you expect a cut on Wednesday?
Yeah, I don't think it's definitive, but I mean, you're going to have a cut, and I think the markets almost universally think it'll be a hawkish cut, and that he will have to give some time to. You have a number of members on the committee that are hawkish, and so I think he's going to cut. I think it's going to be a hawkish cut, but it's definitely not definitive that they go. If they weren't going, they'd probably transmit something in advance. So I think you got to put down that they're going to cut 25.
But you think it should be definitive?
I mean, I think it should be definitive. I think it should be definitive. They go this month, they go next month. Listen, I still think we have room to go. I think once you get to a 3% funds rate, then you stop and interpret where is the data. But I think now, given the deceleration you're seeing in labor and a bit elevated inflation, but it's not really impacted by this interest rate, that I think you can get to 3% without any question whatsoever. I think this committee will go in a more deliberate fashion, but yes, I would go to get to 3%.
You know, Steve Leisman has wondered aloud, I guess is fair to say, whether there should even be a meeting, whether they should just push it off a little bit because they're going to give an outlook which historically is based on data, which there's been a dearth of because of the government shutdown. Do you think you can get an accurate representation of where we are? Can you even take the outlook at face value given the lack of data that's going to go into it?
I do. I mean, so... by the way, I've heard the argument, could you put it off for a week because you get a bunch of data between now and then? It could have been a reasonable idea to do that. That being said, per what I just said, I think the idea that you're going to go 25, there's enough data that we've gotten in terms of what's happening to the job market that suggests that you can go without any real question that you're going to be wrong in that interpretation. Listen, I think when you look at what companies are telling you, what you see from surveys, what you get from JOLTS reports, claim data, et cetera, you got plenty of data on the job market to suggest that you're not going to make a grievous error in still doing that meeting.
You know, I've been looking at rates back up like you have, especially on the long end. You know, here we are at 417, 418. If you're right and we do get a hawkish cut, or if the market's right or whoever you're suggesting thinks that that's going to happen, rates could continue to back up, wouldn't they?
So I think you still could get some elevation of interest rates. Listen, there is a lot of, ourselves included, of people saying, listen, it's been a good year across a series of products, debt, equity, et cetera, and do I step back a little bit before I take more significant risk? So I could see you back up a little bit more. That being said, I don't think rates are going very far. I think ultimately you're going to see rates come down. And so, we've been thinking about, do you start buying some here at the cheaper levels? But I think for the time being, you'd be a little bit patient, see if you get that. By the way, you also get a lot of supply this week, not just Treasury supply. You get a lot of credit supply coming on the market. So to let the market digest a little bit before you jump in, I think could be prudent for a little bit.
What are you thinking about in terms of the impact that what's happening in Japan is having an impact globally on yields, and they're being pushed higher here and other places as well as we watch what's taking place in that bond market?
Scott, I think it's a really big deal when you think about it. I would say today, Japan, the influence from Japan on U.S. interest rates is not nearly as profound as it used to be for a very long series of technical reasons, because it's expensive for Japanese to buy U.S. rates because the cost to hedge the currency, et cetera. But I do think when you think about, the backup in rates in Japan, UK, there is no question there is a greater demand for financing at the government level. You're also obviously seeing credit financing, hyperscaler financing, et cetera. So I think you have to be, when you see those sort of rate movements in places like Japan, UK, today Europe, then it definitely influences U.S. interest rates. So, listen, whenever we're investing around the world, we're thinking about what is relative value, where do you take advantage of it. I think today, quite frankly, when you get backups in Europe, that for us is actually a more attractive opportunity because we get the currency swap effect into it. So, I like buying European fixed income, particularly when you get rate backups like this.
Still.